Hey guys, I'm Greg Hardy, and I want to welcome you to my channel. When you think about investing, it's hard not to think about Warren Buffett. He is widely regarded as one of the most successful investors in the world and is the chairman and CEO of Berkshire Hathaway. Buffett is known for his value investing approach and his frugality despite his immense wealth, which is a staggering $132.1 billion, making him the seventh richest man in the world. Would you believe he still lives in the same home he purchased in 1958 in Omaha, Nebraska? When I seek to learn something new, I want to learn from those who are proven to be successful. So that's what we're going to do in this video. We're going to analyze what Warren Buffett does and apply it to the current economic environment so that you're able to make the most out of your investments. But before we do that, please subscribe to this channel for more content like this. Let's get started. Warren Buffett bought his first stock at age 11, and to this day he focuses on buying undervalued companies with strong fundamentals for the long term. He seeks companies with a durable competitive advantage, reliable management, and consistent earnings potential. Buffett and his company Berkshire Hathaway often invest in companies with recognizable brands and a history of steady growth such as Apple, Bank of America, Coca-Cola, and Heinz. Additionally, he emphasizes the importance of patience and discipline in investing, often holding on to investments for years or even decades. Warren Buffett's advice on investing during a recession is to remain calm and focused on the long term. He often suggests taking advantage of market downturns to purchase high-quality companies at a discounted price. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." This implies that during recessions or market downturns, when others are panicking and selling, it can present wonderful opportunities for savvy investors to buy stocks or businesses at attractive valuations. He advises against trying to time the market and instead advocates for patience, discipline, and a long-term perspective in investing. Additionally, he recommends maintaining a cash reserve to take advantage of opportunities that may arise during economic downturns. Warren Buffett's advice on investing during periods of high interest rates typically involves staying focused on the long-term fundamentals rather than trying to time the market. He has suggested that higher interest rates can affect the valuation of stocks, bonds, and other assets, but he emphasizes the importance of staying invested in quality businesses with a long-lasting competitive advantage. He also believes that over the long term, such businesses can withstand economic fluctuations and continue to deliver value to investors. Additionally, he has recommended avoiding excessive debt and maintaining a diversified portfolio to mitigate risks associated with changing interest rates. While interest rate cuts can impact various asset classes, Mr. Buffett typically focuses on the underlying fundamentals of the businesses he invests in rather than trying to predict short-term market movements. During rate cuts, he may see opportunities to invest in companies that are poised to benefit from lower borrowing costs or companies with strong competitive advantages that can withstand the economic fluctuations. However, his overarching advice remains consistent. Stay focused on long-term fundamentals, be patient, and invest in quality businesses with enduring competitive advantages. When looking to buy a stock, Warren Buffett analyzes the company's ROI, or return on investment. Mr. Buffett always looks at the ROI to see whether a company has consistently performed well when compared to other companies in the same industry. Another thing he looks at is the debt of the company. He examines the DE ratio, or debt to equity. He prefers to see a small amount of debt with earnings growth being generated from the shareholders' equity rather than the money that has been borrowed. Profit margin is another of his considerations because high profit margin indicates that the company is executing its business well. If a company can steadily increase its margins, that means the business has been extremely efficient and successful at controlling expenses. Another key aspect of his approach is his preference for companies with a proven track record of at least 10 years. This criteria reflects Mr. Buffett's belief in the importance of a strong and enduring business foundation. By focusing on established companies, he aims to mitigate risk and ensure that his investments are in businesses with a history of navigating various market conditions and economic cycles successfully. He tends to shy away from companies whose products are indistinguishable from those of their competitors. He wants companies that have a distinguishable element to what they offer and that gives them a protective moat, which is a competitive advantage over other companies. Along with the previous 5 criteria, the company needs to be undervalued. An investor must determine a company's intrinsic value by analyzing several of the business's fundamentals, including revenue, earnings, and assets. The intrinsic value of a company can be higher than the company's actual value. Think about the value of the brand itself. In his view, the intrinsic value of a company represents its true worth, independent of market fluctuations or short-term sentiments. Mr. Buffett believes that intrinsic value is determined by the company's ability to generate sustainable cash flows over the long term. He emphasizes the importance of analyzing the fundamental aspects of a business, such as its competitive advantage, management quality, growth prospects, and financial health, to estimate its intrinsic value accurately. Mr. Buffett famously said that intrinsic value is the discounted value of the cash that can be taken out of a business during its remaining life. Warren Buffett emphasizes the importance of investing in yourself by continuously learning and improving your skills. He advocates for lifelong education and acquiring knowledge that can increase your value over time. He also believes that investing in yourself through education, personal development, and acquiring new skills is one of the best investments you can make, as it can lead to greater opportunities, career advancement, and financial success in the long term. He famously said, "The more you learn, the more you earn." In fact, he said before that he spends up to 5 to 6 hours a day reading books and newspapers. Additionally, he encourages individuals to focus on developing qualities such as integrity, patience, and emotional stability, which are essential for success in both personal and professional life. Warren Buffett is a strong advocate for holding investments for the long term and avoiding any attempt to try and time the market. He believes that trying to predict short-term market movements is futile and often leads to poor investment decisions. From 1981 until 2021, his Berkshire Hathaway company averaged a 20.1% compound annual return compared to the 10.5% compound annual return of the S&P 500. So, despite the ups and downs of the markets, he stayed the course and his gains proved that. Looking at data going back to 1930, Bank of America did a study and found that if an investor missed the S&P 500's 10 best days each decade, the total return would stand at 28%. If, on the other hand, the investor held steady through the ups and the downs, the return would have been 17,715%. To prove that, Berkshire Hathaway has held some stocks for over 30 years. Warren Buffett's longest held stock is likely the Coca-Cola Company. Berkshire Hathaway began acquiring shares of Coca-Cola in 1988, and it has remained one of the company's largest holdings for decades. Other long-held stocks in Buffett's portfolio include American Express, Wells Fargo, and Moody's Corporation, among others. These investments align with his strategy of investing in companies with strong fundamentals and enduring competitive advantage. He recommends focusing on the underlying fundamentals of the companies you invest in and holding on to them through market fluctuations. He famously said, "Our favorite holding period is forever," which highlights his belief in the power of long-term investing. By adopting a patient and disciplined approach, investors can benefit from the compounding growth of their investments over time rather than being swayed by short-term market volatility. Warren Buffett's famous quote, "Rule number 1 is never lose money. Rule number 2 is never forget rule number 1," underscores his emphasis on preserving your capital and risk management. He believes that protecting your capital should always be a top priority in investing. By avoiding significant losses, investors can better position themselves for long-term success and capitalize on opportunities that arise in the market. This advice highlights the importance of being cautious, disciplined, and thoughtful in investment decision-making, prioritizing downside protection over chasing high returns. Of course, over the years, Warren Buffett has lost money on some trades. But what he's getting at is you don't be frivolous and gamble on an investment. Don't go into an investment with the attitude that it's okay to lose money. Be informed and do your research. Invest in what you're comfortable in and what you know the most about. Mr. Buffett advises against carrying credit card debt whenever possible. He often warns about the dangers of high-interest credit card debt, which can quickly accumulate and become a significant financial burden. He also recommends living within your means, spending wisely, and avoiding unnecessary debt. He suggests paying off credit card balances in full each month to avoid accruing interest charges. His philosophy emphasizes financial discipline and prudence, which includes being cautious when borrowing and managing debt responsibly to maintain financial stability and security. Mr. Buffett's investment approach centers on value investing and being able to purchase undervalued companies with strong fundamentals. He emphasizes the importance of investing in yourself, holding investments for the long term, avoiding attempts to time the market, and prioritizing capital preservation. Additionally, he advises against accumulating credit card debt and advocates for financial discipline and prudence. If you want to learn more about growing your wealth, then check out this video right here. But before you do that, don't forget to like and subscribe. Thank you all so much for watching. I really hope you liked this video and that you got something out of it. I'll see you in the next video.